panelists come on up, sit where you like. I'll introduce folks. So we have Sadie McKeown with us. Sadie is the president of the Community Preservation Corporation, and has graciously agreed to join the panel today. So everybody say hello to Katie, or Sadie, I'm sorry.
Sadie, and it's McKeown.
McKeown, sorry.
That's okay.
We're learning on the fly.
It's all good.
And we have Emily Kreps. Emily is the global head of ESG for Deutsche Bank. We appreciate her being here. And Professor Chandan, you met earlier, that has joined us as well from NYU. So let's jump right in. Sam, you're our host, so I'm going to give you the first question, the hardest one. Before we dig into the whole issue of disclosure and some of the things the controller talked about, maybe you can just set a broader stage for us. You sit at the intersection of economics and real estate. There's so much confusion out there. Tell us, how is the market doing?
I think the real estate market is clearly facing a period of challenge. And there is certainly a characterization in the popular press of nothing going right in the commercial real estate market, particularly when we're talking about properties that are located in our urban cores and our most important urban agglomerations in the United States. The locus of this conversation is around deterioration in the utilization of office space, how that's impacted valuations, how that's impacted operating income, leasing activity, our capacity to refinance office buildings. What I would offer as a counterpoint is that our relationship to the built environment is always evolving and changing. It so happens that it is evolving and changing more rapidly over the course of the last couple of years than we are accustomed to. But the real estate industry, the users of space, have a proven capacity to adapt and change, to respond to, that updated and reimagined profile of how it is that we think about our relationship to the built environment and the role that space fundamentally plays in the economic and social production function of the United States. Is it painful to have to adjust and adapt as quickly as we are having to today? Of course. Does space and the built environment still play a fundamental role in facilitating both economic and social activity? Absolutely. And so that element of it remains a constant. The other two things that I'd say briefly are that for those of us who are challenged by some of the difficulties that we face in commercial real estate today, and a lot of those do relate to our capacity to refinance maturing debt in an environment where, again, property performance is sometimes challenged by a decline in leasing activity and occupancy, but that compounded by a very, very abrupt increase in the cost of that financing and the terms of that financing over the last couple of years. What we know about every downturn or period of difficulty in the real estate market is that it has always ended with a recovery. And as long as we keep that in mind and are thinking creatively about how it is that we reimagine real estate and the value proposition of urbanization, there will be opportunities for us. As part of that, and as my final point, I think what we see is perhaps one of the reasons for greatest optimism in the commercial real estate market. We're hosting a conference on called the World Built Environment Forum here with RICS this week. I've just come from the Association of Foreign Investors in Real Estate conference. The conversation and dialogue in our industry around sustainability, around decarbonization, around the relationship of the built environment to our sustainability goals. And not only in the realm of energy efficiency and climate, but also as it relates to the relationship between the built environment and public health outcomes on an individual and community level, is far more important and has risen in prominence in a way that even just 2 or 3 years ago we would not have seen. And so seeing the industry lining up around the conversation around the critical importance of decarbonization, again, is sort of a real reason for optimism for me.
Great. Well, let's carry that theme, Emily. You represent Deutsche Bank, who's done some very progressive things. How does Deutsche Bank approach net zero, particularly the scope 3 emissions that the controller was just talking about?
Sure. Well, first of all, thank you very much for having me. And as the controller said, thank you. So we do have a scope 3 target, and it is an absolute emissions target. So for us, again, scope 3, the majority of it is our financed emissions portfolio. So we actually, in March of last year, published our financed emissions for the first time. You can look at it on our website. It's our Towards Net Zero report. And what we did is we took our 4 high-emitting sectors and we published that relative to our corporate loan portfolio. Now, we found that 3 sectors make up 68% of our financed emissions. And then in October of last year, we set specific decarbonization targets for those 4 sectors for 2030. So those are interim targets. So in 2021, we set our 2050 net zero target. We said we will be net zero in our corporate loan portfolio by 2050. And then in 2022, we said for these 4 sectors, this is how we're going to get to net zero this is the pathway that is aligned with the IEA net zero scenario that we'll see in 2030, so that this is the checkpoint. And we will release similar targets before the end of this year for 4 additional sectors. Now, this is not easy, and obviously there is pushback. Our objective is not to abandon our clients. We don't, and there is a business selection element that comes with this. But our expectation is that our clients transition with us. Because if our clients don't transition, then we can't transition because we don't have control over how they choose to operate their business. So these are conversations that we have to have with our clients on a consistent basis. And then at some point, you know, if they are not aligned with our pathway, then we make challenging decisions.
So has it changed how and who you loan to?
What has changed is how we make the evaluations. So we do have a coal policy, which we have again updated with respect to thermal coal, met coal, and such. We do have an oil and gas policy, and that does, yes, change to whom we lend. And I would anticipate that those policies continue to tighten as science continues to tighten. You know, I would respond to one of the comments that the comptroller made about science-based targets, and there are no defined pathways for science. There is no SBTI methodology approved for financial institutions yet. We are very much committed to science-based targets.
Right, so they're doing buildings first.
They're doing a lot of things first.
I know they are. So buildings are coming this fall, and so look for more for us on that. We're going to be doing, Ellen just reminded me, we're going to be doing audience Q&A for the panel here. We're using Slido. So you go to slido.com on your phone, and you put in the code DECARB, and you can enter any questions that you like for the panel. You can vote up questions, and when we get to the Q&A section, I'll take a look at my iPad, and we'll get the Q&A. So thank you, Emily. Sadie, you've done great work related to decarbonization and affordable housing. Can you tell us more about that?
Sure. So CPC, my company, we're a not-for-profit mortgage finance company. We do construction and permanent lending, primarily a New York-based company, but we have a national footprint and we have products nationally. We are a carbon neutral company. Scopes 1 and Scopes 2 every year. We measure Scope 3 every year. We disclose, and some years when it's not too expensive, we offset. We just bought into a large NYCHA bundle, New York City Housing Authority. Our emissions went way up. That was tough to offset last year during a tough year. But Scopes 1 and 2, we are carbon neutral, so we're proud of that. But in 2008, CPC really took on sustainability because there was a great recession, and we're in the affordable housing business. And so for us in 2008, it was about helping our owners use less energy so that they could save money, which would keep pressure off of rising rents, and keep those buildings more economically sustainable. So at the time, green was truly money. It was really just about saving money. And then because we are a great partner to government, government's a great partner to CPC, we moved along the continuum from energy efficiency to deep energy efficiency. Then we picked up Passive House. Then we moved on to electrification. And now, where we sit in New York, both city and state with the laws on the books, we are focused on full decarbonization of the buildings that we finance. We've created tools for lenders. So our platform is that there are lots of great incentive programs. And I love my utility and my SORTA incentive programs. They're great, but they are a grain of sand on a beach for the amount of capital that we actually need to move the needle on buildings. And so the majority of money for buildings comes through the first mortgage markets, period. First mortgage capital defines what buildings look like and how they get constructed and how they get renovated. So from our perspective, let's use our first mortgage capital. It made so much sense to us. Let's just increase the proceeds, pay for the money, they're going to save, and so we'll underwrite the savings. Well, in 2008, no one would talk about underwriting savings, and no one would talk about taking that additional risk. I will say Deutsche Bank was one of our partners in a failed program we had called the Neighborhood Energy Loan Program, NELP, worst acronym ever. But it was because we couldn't get capital providers to take the risk of underwriting to energy savings, which to us, after financing renovations for, at the time, 35 years, made so much sense. When you underwrite a building that has leaking plumbing, you underwrite to a different water number after rehab because you're replacing all the plumbing. And so for us, it was very practical, but we couldn't get a lot of traction. So we wrote a guide about it, and we wrote a guide about high performance. Then we created some technical tools to help owners understand if they did different levels of renovation at their buildings, what they might be able to save. And now we're working on creating a database of performance comps for different building types. So if you're going to build a passive house, I literally have financing partners that say, we don't really believe in passive house. So we're going to use the underwriting standard from your fossil fuel-based portfolio of 5,000 units that are old buildings that are using oil. And so it's been very challenging for us. So it's been primarily an academic exercise because it's hard to get lenders to move towards doing this. But we institutionalize sustainability. Every document we have at CPC. I want to give a shout out to Elizabeth Kelly, who took us through this when she was at CPC. Literally every single department at our company has to address sustainability in the work that they do, from the very front end marketing materials to all of our asset management. And then we try to influence and work with government to bring them along. And I'll just give you one example. We were very strong advocates for a state housing finance agency to increase or to change their QAP for all of their affordable projects to require at least new construction be all electric. And they did that. And then we worked with advocating with NYSERDA, who has all these great incentives, to just put the money into HFA and have it be a seamless transaction so that you wouldn't have another set of documents, another set of lawyers. I will tell you, if you're in affordable housing, you sometimes the deals have 13 sources of capital. So making things easier, especially when the goal is decarbonization, which is really hard, making the money easy is really important. And so that was a very successful program. And we're working on a bunch of other cool stuff too.
Great, thanks. Sam, a lot of discussion on disclosure with the controller and part of the discussion now. Here, how do you see disclosure changing the real estate industry?
Sure. I mean, I think if we look at historical examples of mandates for increased disclosure in the real estate industry, whether they relate to carbon emissions or financial performance, almost universally they have been a positive. And so when we look at sort of the evolution of the REIT sector, in the United States, and the way that allowed for a greater formalization of real estate markets, a greater level of liquidity in real estate markets, both in terms of the equity and the availability of the debt. I'm a firm believer that while we will invariably face pushback, on any mandates or requirements, or perhaps even just suggestions of greater disclosure, that the net benefit to the market, both the industry and the sector, but as a social good, is almost without question positive. And so I would frame it in that context. If I can add one more thing, sort of as a follow-up to your characterization of sort of some of the challenges you faced in 2008 and 2009, it's a really interesting parallel for me to a little bit of what we're seeing today, particularly as it relates to questions around how we might encourage adoption of or utilization of C-PACE financing in New York City and elsewhere. I think for a lot of lenders, in the office sector and others, they're going through a process where price discovery in real estate is impaired. We don't have a lot of transaction activity right now. Volumes are down. there's questions about, well, what is actually trading and is it representative of the market? And every lender is every balance sheet portfolio lender is having to go through the process of carefully triaging which assets might be over-levered and which ones might be okay. And the vast majority are have got some cushion there, right? It's going to be in the tail of the distribution that we have some office buildings, some apartment buildings, some retail properties that in an environment of higher rates are going to be underwater in terms of their leverage. The prevailing environment of risk aversion in the market with regard to valuations has meant that many of our green financing programs, at least for the time being, face this additional headwind of folks saying, I understand the importance of it and I need to do it. The idea of going to my loan committee and saying, hey, I want to subordinate my senior loan to this additional layer of debt that needs to come into play, and is sort of the lowest cost option for how I make the carbon improvement to my property. You're getting a loan committee to sign off on the idea of subordinating my senior loan to this additional piece of debt that by design sort of takes a senior role. It's through the tax lien. We're at a point in time where, just given where we are in the valuation cycle, that's often a difficult sell. Anything we can do then, to help educate and inform the market, lenders, borrowers, city officials, and others with regard to the range of financing opportunities that are available, and how it is that when we look past sort of the immediate issues with regard to the valuation cycle, the carbon improvements are, improve the bottom line in terms of property NOI, but also make these assets more liquid. What was really clear for me coming out of AFIRE is that there was no large global institutional investor today. There was no major global pension fund, whether it's from Canada or Europe or the Gulf states. There's no sovereign wealth fund that when they're looking at an acquisition today, is not also thinking about what will the exit environment look like for that investment in 5 to 7 years' time. And the prevailing consensus, with very few exceptions, is that if I do not invest in an asset today that is green or that can be greened through one of these programs over the course of the next 12, 24, 36 months, I'm going to find myself in a world of trouble when I have to dispose of that asset in 7 years, because the market for an asset that has an unfavorable carbon profile in 5 to 7 years will be infinitely inferior to where it is today. And that's one of the biggest things we see here. It comes back to your point about sort of having to sort of maybe sometimes pick and choose who your clients and partners are. I think we see large institutions, whether they be on the lending or the investment side in the United States and elsewhere around the world. Europe's quite frankly ahead of us in this regard, and we've got regional differences in terms of how state governments and others are approaching it, within the United States. And but by and large, I think what we see is that the big institutions are setting the terms here and saying decarbonization needs to happen, and liquidity for assets that don't have the capacity to green is going to be long-term imperative.
So, thank you.
Sorry.
No. Emily, we heard there's a wide range of, should we say, commitments to disclosure from banks. There's a wide range of activities, and Brad outlined some of those. Clearly, Deutsche Bank is in a different place. So what are the factors that have driven Deutsche Bank to pursue the net zero goals that you have in the way that you've done it, and to disclose the emissions in the way that you've done it?
Well, there are a couple of factors, and so today is my 2-year anniversary at Deutsche Bank, so I can't take credit for thank you for everything.
But now tell everybody where you were before.
So I joined Deutsche Bank from CDP, the former Carbon Disclosure Project. So if we want to geek out about disclosure, I ran the capital markets work there for 4.5 years. So if you really want to geek out about disclosure and my thoughts there, we can have that conversation. From Deutsche Bank's perspective, we were a founding member of the Net Zero Banking Alliance, and that was an important commitment for us in April of 2021. And the requirements of commitment there has driven a lot of that activity. Our CEO, our group CEO, Christian Saving, he made sustainability part of a three-pronged strategy starting in 2019 as well. And that was something where he said for the next decade, sustainability, digitization, and macroeconomic uncertainty were going to govern how he saw the future of the bank. Now, this is before Russian invasion of Ukraine. So these are all factors that have led to how we have approached this from the top down. And we also have a regulator in the ECB that has also put this at front and center, and we can't discount the role that plays in the process as well.
Do you have other stakeholders, your own investors, customers that are pushing you in this direction that maybe we don't see yet in the United States?
Absolutely, and certainly we have shareholders from our retail shareholders to our institutional shareholders who ask about it. We have the NGO community that engages with us. We have customers. As of January of this year, the German Supply Chain Due Diligence Act came into force, which again requires us to talk to our clients or anyone to whom we provide services to provide disclosure around these topics. So all of these have been in the works for quite a while, and so there's that kind of regulatory push in addition to some of the strategic directives that have been made by the bank as well.
Okay, great. We're going to get to panel questions here in just a few minutes. So remember, slido.com, and the code is DCARB, and you can type your questions in there and we'll take a look. Sadie, what role do you see emissions disclosure playing in real estate from where you sit?
So when I look at mortgage lenders in particular, but capital moves for three reasons. Private capital, capitalism, profit, and everyone will tell you, every banker you talk to will say, I have to honor my shareholders, I have to make a profit. I appreciate that. I have investments too. Okay, so I care about that. So they move for profit, they move for regulation, and the best example of that from my world is the Community Reinvestment Act, which drove trillions of dollars into low and moderate income communities over the last 5 decades and changed them dramatically. And then they move for fear of litigation. And so when you think about it from that perspective as a real estate lender, and you look at the third-party reporting requirements when any lender is making a loan on an asset, there's the value through the appraisal, that's great. There's the engineering report, and there's the appraisal. There's the phase 1. Energy efficiency sits in the engineering report and many times gets value engineered out of the project, especially in affordable housing. We have an affordable housing crisis. You can't use precious affordable housing resources to pay for high performance. But if you moved carbon and you stop talking about energy efficiency and systems performance and you talk about carbon and decarbonization, carbon should really sit in the phase 1. Right? And so if we are required to start disclosing carbon in the investments that we're making, then we're looking at it with an environmental lens. And I promise you, because I was a lender for 20 years at CPC, you stop at a point in the process of making a loan, and you look at your phase 1, and if there are any liabilities in there, you're forced to address them before you can close. And so radon has been mitigated that way. Asbestos has been removed. Lead paint has been remediated. None of these things make anybody money. None of them have a payback. And all of them cost a lot of money. And so the conversation has been sitting in the wrong place from my perspective. We tried to have it looked at in 2008 as an environmental thing, and people looked at us like we were crazy. No, it's about energy efficiency. It's about saving money. No, it's really about carbon and about getting it out of buildings. So I think disclosure accelerates that, and the IRA has called carbon a pollutant. So we have an opportunity now to take carbon and put it in the phase 1, and that will move the real estate markets.
That's great. Thank you for that answer. Emily, before we run out of time and get to the panel questions, I know Deutsche Bank has a really interesting residential mortgage program in Germany. Can you tell us about it?
Sure. Well, and I think what you're referring to is we published a white paper earlier this summer on our residential mortgage portfolio. So just to give you a sense of scale, Our commercial lending, and I actually had to write these numbers down, our overall real estate lending is 251.8 billion euro, of which 182.3 billion euro is residential. Of that, 175 billion euro is in Europe. So not surprising given we're a European bank. And of that 175 billion euro, 171 billion is residential. So when you think about where residential real estate and mortgages falls for us, it's obviously a really critical component. And one other data point, I talked about our corporate loan portfolio and the financed emissions. That's 110 billion euro that we are measuring. So just to give you a sense of scale, this is a really critical component of our decarbonization strategy. So we published a paper earlier this year about the fact that this is incredibly important. Now, all of that being said, those three sectors that I talked about representing 68% of our corporate loan portfolio, our corporate loan portfolio has 30.8 million tons of CO2 a year. Our residential mortgage portfolio has 3.9 million tons of CO2. So it's a factor of 10 and 2x, right? So that's not to say, but that being said, it's an important and critical component of our business. And we also know that there are various building codes with respect to the age of buildings and the real estate resale value that come with that. So we've created various financing products to ensure that our clients retain the real estate value, have the opportunity to retrofit, particularly around energy efficiency and such. And so this is outlined in that paper. I would encourage those of you who are interested, it's on our website, and happy to talk further about it.
Great, thanks. And Sam, take us home before we get to the audience questions here. What gives you hope about the future? Like, as you think through all of these issues and the market trends when it comes to finance and real estate, what gives you hope?
Sure. I'll reiterate my previous point. I think when we actively engage in listening around the conversation that the real estate industry is having today, whether it be the lenders or the institutional investors, the focus on sustainability initiatives, and in particular around the decarbonization of the built environment, is so much more prominent today than it was even just a couple of years ago. And in many cases where we have not had champions for decarbonization of the built environment within individual real estate firms, what we now very, very clearly have is a recognition that the liquidity and value of your asset will be impaired, if it does not meet the market and policy and public expectations around what a clean building will look like. And I think even in parts of the United States where the political headwinds facing decarbonization efforts can seem sometimes overwhelming, we see the pressure from pension funds and others to say, I simply cannot, from an economic perspective, from a financial perspective, I cannot afford to deploy capital in an investment that doesn't have the potential to green over the course of the next couple of years, because my mandate and my obligations as a fiduciary are to all of my policyholders. I am not able to make an investment where the E, particular in the ESG, is not part of the investment and decision-making criteria, because I will not be able to deliver the kinds of financial results that I need to, as part of the role that I have in the marketplace today. So, whereas several years ago, we were really relying upon there being sort of a climate champion, within the organization to drive a culture shift or a shift in thinking around why it is that we need to make this a priority, the social imperative of doing it. Right now, I think we've moved to a place where it is seen as a financial and economic and profit imperative as well. And that's what we need to have happen, to get the C-suite on board, across, across a broad cross-section of firms in our industry.
Great. Okay, we got lots of questions coming in, so I encourage you to go to slido.com with the code DECARB. First question here with 3 upvotes. You can upvote. From Max. Thank you, Max. The first question here is, what financing solutions can solve the owner-renter cost split problem in residential building retrofits? Sadie, you want to go first?
Well, It's a good question. I think the cure-all is really low-cost capital. In this environment, that issue only gets worse as the cost of capital increases, because somebody has to pay for it. So the split is tough. I mean, I'm in multifamily, and most of the properties that we finance, tenants pay their own utilities, and then there's common heating. So it's split that way, and if the resident wants to save money, they change their light bulbs and they put on a sweater, right? I mean, they determine their destiny. So it's a tough question, but I want to just pick up on what Sam was saying about the change in the way people are thinking about it and talking about it. It's absolutely true. And with respect to the IRA, inside the IRA is $27 billion for nonprofit lenders in the Greenhouse Gas Reduction Fund to decarbonize the economy, essentially. Solar distribution, transportation, and buildings. And I can promise you that in our world as nonprofit lenders, we follow the money. I think that's why they put the money in our world, because we follow the money because we have no choice, right? We're not banks, we can't pull down cheap capital from the government. We have to figure out how to use resources to drive our own priorities. And for 90% of nonprofit lenders, 12 months ago, sustainability was not a thing. And now, 90% of us are chasing the money, right? And talking about sustainability and hiring people and pushing. And oftentimes it starts with us. Just like with the Community Reinvestment Act, it was the nonprofit lenders that animated those markets so that private capital could come in behind us. We create that investment environment, we show how it can be done, and then private capital comes in. When the private capital comes in, that's when you start to accelerate and get to that tipping point, and then you get to business as usual. So we're in that very uncomfortable early phase, but we're all talking about it, and we're all chasing it, and we're talking to Deutsche Bank, and we're talking to Citibank, and we're talking to Wells Fargo, and Brad Landers, who is giving us a letter of support, because we're making an application for this capital. So it does happen, and it's not at all an answer to the question, and I apologize.
We have about 6 minutes, because then we're going to look at the tools. So we're going to get through as many questions as we can. The next one, and I'm sorry they keep bouncing around here because you keep upvoting, which is great. How much, from Michael, how much impact does the cleaning of dirty grids like New York City have on reducing owners' desire to act now? Will we or can we have separate disclosures on that? So I guess the question is, you have a dirty grid, should you wait? I have an answer on that, but Emily, maybe you can go.
Sure. So here's the reality: an electron's an electron. And as much as we in New York City, if you're a New York City resident, can choose your energy provider, you have no idea where that electron actually originated from. You can pay for green energy. The only way you'll know it's truly green is if you generate it yourself. All of that, all of that being said, the most control you will have is exercising your own energy efficiency. And this is where, if we look at greenhouse gas emissions as a total, 40% comes from heating and electricity in residential usage globally. So that's where, while we may not be able to have control from the grid perspective.
Right, and I encourage you to look at Urban Green's Going Electric report. In that report, we took on this issue and did some research, and what we found is even with a dirty grid, if you electrify, you save carbon because the heating system is more efficient. So you're just using less energy, and then over time, you have the benefits of a greener grid. Next question here: since mortgage lenders sell the loans and the risk to Fannie and Freddie, don't we need Fannie and Freddie to move first?
So we have licenses, 5 licenses with Freddie and Fannie, and that is at the heart of our effort, is to try and get Freddie Mac and Fannie Mae to adapt deeper green standards. On the multifamily side, they have green programs. It's pretty light green, And we're trying to use this IRA capital to get them to go deeper. Where Freddie and Fannie go, that's where the mortgage markets tend to follow. I will say that the White House is also irritating FHFA, the Freddie and Fannie regulator, to increase the building code standard that they will make mortgages to properties that only meet a certain standard. And so everyone is sort of eyes on Freddie and Fannie right now. How can we poke that bear? Because if they move, then markets do tend to move with them.
Okay. Keep the microphone, Sadie. Next one for you. Can you please explain why lenders are not interested in the Passive House standard? What's being done to increase education?
The first conference I ever spoke at about Passive House, I started by saying it was affordable housing, supportive housing conference. Passive House is not a group home for lazy people. It is primarily a lack of awareness. People just don't understand. And then it's complicated. Lenders sell capital. Originators sell capital. They're like car salesmen, really. I mean, that's what they do. And if anything makes it harder, they don't want to do it. And so more and more conferences and more education is out there about Passive House. Passive House has also got a little bit less OCD. So you don't have to get all the way to that FIAS standard, and you don't have to obsess about it, and you don't have to wait for your incentives until 2 years after. A lot of the original stuff is relaxed a little bit, and people are now, I think, appreciating there's more data. People are appreciating how much money you save by using so little energy. We can't control the cost of the commodity. We can only control what we use, and that's the way to use the least. The other thing is, I think there's more out there, so you can actually walk through a Passive House building now. You can do an inspection. That's a great thing. Somebody's lending money, they like to go there before, and they like to go there after. And if they go there after, and it's quiet, and it's clean, and it's beautiful, then people can see it and touch it. That really helps too.
Okay, I'm going to try to do 2 more questions if we can do them quickly. This is a really interesting question. If I make hard hats, is my scope 3 higher if I sell them to Chevron versus Brookfield Renewables?
No.
Then it's a good question. Then the person goes on and says, let's replace hard hats with money. Do all banks agree on scope 3?
All banks agree on scope 3. So in principle, the banks that have come to the table and whether it be made commitments or come to working groups, a lot of us have coalesced around PCAF, which is the Partnership Carbon Accounting Financials, and that's the greenhouse gas accounting standard for financials. There are different asset classes, including mortgages, car loans, corporate loans, and so on and so forth. And then from there, banks will then, and this is for both on-balance sheet and facilitated emissions, from there banks will then may tweak that methodology for their own, I'll say, use. So in terms of a methodology to calculate scope 3 emissions, that may differ. Do all banks agree that they should calculate and report and reduce scope 3 emissions? That really depends on who is in the C-suite.
Okay, final question here for the panel. Actually, there's 2 questions, but the final question sets up our next presentation. But the next to final question here is anyone developing a securitization labeling standard that would appeal to climate investors? Sam, you want to take that?
I mean, what I can speak to very briefly is that on the commercial real estate side, where, again, keeping in mind as compared to residential, and where there's an outsized role for Fannie Mae, Freddie Mac, and the FHFA on the commercial side of the market, while we do have a CMBS market that has its own sort of ups and downs, the vast majority of loans are held on balance sheet, whether it be a bank or a life company or other participant in the market. On the securitization front with the CMBS product, there is an investor reporting package that clearly articulates information that has to be shared and included as deals come to market, as deal performance updates are made. and Kreps, Commercial Real Estate Finance Council, which really oversees and builds consensus in the industry, is introducing and has introduced a number of metrics that do help investors in the bond market in particular gauge exactly what not exactly, but certainly gauge and have a better understanding of and better insight into sort of what the green profile looks like.
Great. Okay, ladies and gentlemen, let's thank our panel. Really appreciate that. Our very last question was, with huge variation in paths for decarbonization financing and incentives, what tools exist? And so that's a great lead into the final part of our program today, which is Kendra Gibbs, who's going to demo the Carbon Compass, which has been a collaboration that we've done at Urban Green with NYU, on a new tool to think about Local Law 97. So I'm going to turn it over to Kendra to do the demonstration.
Yeah. We're going to start with a little intro from Mariana Koval, who could not be with us today.
Sorry that I can't be there with you today in person, but I'm delighted to present the Decarbonization Compass. The data tool began in a partnership with the Mayor's Office of Climate and Sustainability, now the Mayor's Office of Climate and Environmental Justice, more than 3 years ago. This new iteration, free and publicly available, should be valuable to a wide range of stakeholders, including property owners, service providers, policymakers, PACE originators, and mortgage lenders. What makes this tool unique is that it includes mortgage lender information for those properties subject to Local Law 97 and shows lender portfolios with their total carbon emissions. We believe this will help mobilize existing mortgage lenders to work with their borrowers and bring green finance to decarbonize these buildings. NYU Stern will be publishing a white paper next week during Climate Week, outlining some of the models and opportunities for the mortgage banking industry to do that. I have to thank a few people who have worked very hard to make this data tool available to you today, including Sahil Jain, Pratik Seth, Max Wang, Adam Shiabor, and Rebecca Hume. Many others have contributed to this work and are recognized on our website, but I have to particularly recognize Miles Draycott and Gary Friedland. Thank you. Let me turn it over to our Assistant Director, Kendra Gibbs, who will demonstrate the tool.
Hello, I'm Kendra Gibbs, Assistant Director for Invest NYC SDG at the NYU Stern Center for Sustainable Business. I'm delighted to be presenting the Decarbonization Compass to you. This data tool began in partnership with the Mayor's Office of Climate and Sustainability, now the Mayor's Office of Climate and Environmental Justice, more than 3 years ago. This new iteration of the data tool, free and publicly available, should be a valuable tool for a wide range of stakeholders, including property owners, service providers, policymakers, PACE originators, and mortgage lenders. What makes this tool unique is that it includes mortgage lender information for those properties subject to Local Law 97 and shows lender portfolios with their total carbon emissions. We believe that this will mobilize existing mortgage lenders to work with their borrowers and bring finance to decarbonize those buildings. There are many data tools out there. The New York City Accelerator has a great tool that allows you to look at an individual's building's energy use and compliance with Local Law 97. Our tool is unique because it is the only one that includes data on lien holders. So you can look at lender portfolios and see their total Scope 3 carbon emissions and Local Law 97 penalties. That's a very useful piece of information for lien holders, property owners, and service providers as we look at mobilizing stakeholders. Our tool also allows you to look at an individual property. You can search by mortgage lender, address, or BBL. To see and compare a large number of buildings, you can filter by location, building details, carbon emissions, and Local Law 97 compliance. You can also search geographically if you want to understand the carbon emissions coming from the buildings in your neighborhood or your borough. If you have a burning desire to understand the carbon emissions of your favorite museum or your university, you can filter by property use type. You can also search by securitized mortgages or city-owned buildings. And you can layer filters. So you could look at city-owned buildings built before 1975 and filter for the number of carbon emissions. If you are a service provider, this tool could really help you identify a market. I find this really interesting. If you pull the building emissions up to 6,000 megatons of CO2, we see that there are about 199 properties that are contributing 20% of the local law 97 carbon emissions. That's just 200 buildings. Interestingly, a good number of these buildings are hospitals, which means they won't face penalties until 2030. And finally, we can see when these buildings are required to comply with local law 97 in 2024 compared to the buildings that are going to be required to comply in 2030. My favorite thing to do with this tool, besides playing around with all the different filters, is to search by mortgage lender. So let's look at JP Morgan Chase's portfolio. You type your mortgage lender into the search bar, and here we go. We can see Chase's portfolios of buildings in New York City. So they're the lender for 1,209 properties, 1,209 properties in New York City that are contributing 470 metric tons of CO2. Interestingly, the majority of their buildings are using natural gas, but there are still some buildings that are using fuel oil. Let's see, there's a big building here that'll have significant penalties in 2030. This one as well will have significant penalties in 2024 and 2030. There's a lot to learn and explore in this data tool. We welcome everyone's feedback and advice. We are updating the securitization data and adding the mortgage maturation data for mortgages that are captured in this data tool. We think that this is an important step because it's one natural time where the building owner is looking for money to refinance. And this is the point where the refinance package can include money for decarbonization. If you want to play around with the tool, please check it out at decarbonizationcompass.nyc. I have to thank a few people who worked very hard to make this data tool available, including Sahil Jain, Kritik Sek, Mac Swang, Adam Shiabor, and Rebecca Hume. Many others have contributed to this work and are recognized on the website, but I have to particularly recognize Miles Draycott, Gary Friedland, and Mariana Cabal. Thank you.